I think it's going to be really steady. There's a lot of good opportunity left for hotel lending. The supply and demand is in good shape, so I see a steady hotel lending environment.
I would say the lending environment for hotels has come a long way since the recession. There's certainly ample capital, whether it be CMBS loans or alternative sources of capital. I think there continuously will be capital for hotels. However, there are cautious areas where valuations become too high. But I think for the foreseeable future, will be capital with some bumps along the way.
Well, I think you have some interesting events occurring. Again, we talked about it earlier with the CMBS wall occurring. I won't say wall, but a lot of maturities occurring later on this year, as well as retention occurring, which may take some CMBS lenders out of the market. I think we have some great opportunities coming up that we could really look at some good deals out there. And I think there's also some alternative financing sources with opportunity funds and other groups that are really going to be able to put together some good financing packages. So I feel pretty good about opportunities over the next, call it 6 to 12 months.
I think on the new construction lending side, we're going to see that tighten a bit. Lenders are going to be more particular about what sponsors they lend to. Some creative financing may come into play in order to get the overall leverage that the developer needs. But from an acquisition and repositioning standpoint, I think the debt availability will remain strong.
I'm pretty optimistic about the lending environment right now. There's ample capital for the right deals with cash flow, with good sponsorship, good brands, and good markets. And lenders are being cautious for deals that are weak in one of those equations, whether it's on the acquisition side for people overpaying, so there isn't overlending in the marketplace, and there is not people chasing money for new development deals. So deals that work can get financed. We're very busy, and deals that don't work are being turned down, which hopefully will make the cycle last longer.
I think the lending environment in the next 12 to 24 months will be prudent. I think there's a lot of information out there for lenders, and they're being able to be choosy right now. While it's a good time to borrow for rates, there's a lot of transactions out there, so lenders are able to pick and choose with the deals they feel are the best, which probably goes back to my previous point of view, having a well-organized, thought-out plan when you present to a lender. It gives you the best chance of success in the transaction.
I would say that the lending environment is shaping up relatively well, favorably for the next 18 to 24 months. Given that new supply is relatively constrained in a lot of the submarkets that we're tracking, I think that as long as lenders remain prudent, there are going to be ample opportunities to lend on stabilized properties as well as acquisition repositionings, and very selectively new construction. RevPAR remains positive in 2016, and early indicators are that expected across the U.S. RevPAR is expected to grow 2 to 4% in 2017. So, given all of that, I believe that we're in a good environment, positive sort of upward-leaning environment for the next 18 to 24 months.
I could speak to that more as a construction lender from a construction lender's perspective. And what I'm seeing now is I feel like it's kind of in a transitionary period. There's certainly, with new regulations that have been introduced under Basel III, classification of loan types as high volatility commercial real estate. Banks are essentially being disincentivized from being aggressive about doing construction loans. So you definitely see alternative lenders such as ourselves that are attempting to step in and fill the void, and then there's a number of others. So cost of capital is a little bit different when you compare what traditional banks have done in the past versus what a private lender is doing. But the good news is that there's optionality there. Developers just have to kind of get a mindset that they can still pay a higher interest rate versus a bank interest rate and still make the kind of returns that they need to get a project done. So, we'll see how it plays out over the next 18 months, but definitely seems transitionary, although, again, optionality is out there for borrowers.
I think what you're seeing is a gradual tightening of lending in the business. As you see banks that hit limits and you find borrowers that hit limits, There's still plenty of other lenders that are out there, but you have to be able to identify who's the right kind of lender for you, right? The kind of positioning, whether it's new construction, acquisition, refi, renovations, PIPs. There's money that's out there that will be available. Some lenders are fickle and end up leaving. Find the people that are committed to the business, that know that'll be there for you in good times and also bad times.